All right. Good evening, everybody. Let's go ahead and get started. Want to welcome you guys here. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that that is indeed working. Like I said, I want to welcome everybody here. Want to give a shout out to those of you who are watching this in the recording on the website. Want to say hello to you guys or anybody who may be watching this on YouTube. Want to say hello to you guys too. Tonight, I'm really excited. This is probably I guess my favorite night so far in the course that we've been running. This is class 7 of 10. So we're moving right along through the options trading course. And we're now to the part where we finally get to talk about building strategies. We started, I guess, 2 weeks ago with debit spreads, and then we got into credit spreads last week. And then this week, we get to take it to another level where we get to discuss iron condors and iron butterflies, which are neutral theta harvesting strategies, which I'm super excited to talk about because these are my favorite strategies when it comes to options trading. They're defined risk systems and they're also very high probability systems as well. So the chance of success is very, very high. Most people who go on an iron condor route of trading typically do well, even if you don't have very much experience. The market is generally pretty forgiving to people who trade iron condors. If you do it, I mean, if you have at least a good couple of like if you trade an iron condor, it doesn't take a lot of work to put together a good system. Whereas a lot of other buying systems and directional trading option strategies do require a lot of research and homework to make sure that you're buying stuff that actually is going to do well. So, like I said, the iron condor is a great place to trade, and I'm excited to go into the mechanics of it. Couple of goals tonight. Tonight, we're going to go over what these two systems are, just generally speaking, from a structure standpoint. And then I'm going to teach you guys how I trade the Iron Condor. There's actually two different ways I trade it. And I'm going to show you how I built a scanner to find Iron Condor trades. And I'm going to show you how I do a daily SPX S&P 500 Iron Condor. So that's going to be super exciting. This is probably where I make most of my money from options trading is this particular strategy. So I love all the other types of systems. As you guys know, sometimes it's time to buy options like buy puts and buy calls, and those are great too when those opportunities come along. But if you're just trying to create income for yourself and have something that's consistent over time, this is it right here. And this is also where most professional traders like to be, is in this iron condor neutral to theta harvesting type of system. So let's go ahead and jump into it. Before we get started, as always, I need to remind everyone about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many contracts you're taking on each trade and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process of analyzing risk each time you take a trade. Also know that I'm not a financial advisor and past results don't necessarily are indicative of future results. So just keep that in mind. But perfect. Let's go ahead and jump into this. I'm just a guy with a trading computer, a trading account, and some trading ideas. That's so take it for what it's worth. Okay, so like I said, today we're going to talk about the Iron Condor and Iron Butterfly. These are neutral trading strategies, how theta works in your favor, how to manage range-based trades. We're going to move a little bit quickly in the beginning here, guys, because I do have lots of slides to get through. And then also at the end, I want to get into how to trade the at least the SPX version of the Iron Condor, which is my favorite way to trade the Iron Condor. So we want to leave time at the end to do some examples and show you how to do that and get into the trading account. So we want to leave some time at the end there. Okay, so big shift. So far, we've learned buying directional strategies, that specifically debit spreads. We learned a few weeks ago, and last week we talked about credit spreads, which are slightly directional strategies. They're also theta harvesting type strategies. The Iron Condor is a max theta harvesting strategy. Same thing with the Iron Butterfly. And so we're going to get into that in just a second. So most of the time, you guys have heard me say this before. 20% of the time, the market does 80% of everything, right? And then 80% of the time, the market does nothing. So one of the biggest challenges in trading is that period of time when you're a directional trader and you're speculating price, you're waiting so long for a trade. For example, you guys know this morning, We had a really great overnight trade on the half box. It was absolutely amazing. And then we also had that huge win on the pound franc, that sentiment trade that we've been waiting for 2.5 weeks on. Both of those were directional strategies. And yes, when the market moves in the direction you're wanting it to go in a big way, it's huge. It's just crazy profits all at once in a very short period of time. But the rest of the time, what are you doing to make money, right? Like a lot of directional strategies, you just have to deal with the fact that the market's not really doing anything. So there are other systems that are kind of more exciting when the market's doing nothing, and that would be the Iron Condor. So the cool part about Iron Condors is usually they have, if you're doing it well, you're having like a 90 to 95% success rate with the Iron Condor. Um, if you don't really have a lot of filters and if you don't have a good way to sift through the Iron Condor, just randomly throwing Iron Condors out there, especially if you have like a 20 delta or 10 delta strike price for your Iron Condor, you're typically looking at a 80 to 90% success rate. That's without any filters or any type of analysis. So just kind of shooting darts out there. It even has a successful success rate. Not saying you'll make money just throwing darts out there, but you could even make money just doing that. Okay, so very good. So let's talk about the Iron Condor specifically, what it is, the structure of it. Okay, so this is the fun part. So an Iron Condor is a call credit spread and a put credit spread. That's really all it is. So last week, if you watched the class, and if you didn't watch last week's class, I'd highly recommend you go back and review it because every class builds on itself, right? As you'll learn today, if you haven't learned that yet, everything builds. So a call credit spread is basically what? Let's kind of review what we learned last week. Call credit spread is you're selling a call and you're buying a call at the same time. Okay, so you're buying an in the money call, or not in the money necessarily, but a closer to the money call, and then you're selling a further out of the money call, and that creates a spread. Okay, because the difference between selling a call that's closer in value to one that's further in value is going to create a net difference, and that's called the spread. Okay, so that's a call credit spread. A put credit spread is where you sell a put that's closer to the money or at the money, and then you sell another put, or excuse me, not you don't sell another, you buy a put that's further out of the money. When you buy a put, it costs you money. When you sell a put, you create income. You get money for selling the put. Now, since you're selling a put that's closer to the money, you're going to get a larger credit for that. And then when you go buy insurance and buy that other put to protect against that put, you are spending money in that process. And the difference between those two strike selections is going to create a spread and a credit that you get to receive, and that's called a put credit spread. So an Iron Condor is simply, like I said, a call credit spread, which is two legs in itself, and then you have a put credit spread on the other side. And in total, there's four legs to an Iron Condor. And the goal with the Iron Condor is for the market to stay right in between. You want it to stay right in the middle of your call credit spread and your put credit spread, because if the market stays in the middle by expiration, you get to keep both the put credit spread uh, money, the full amount, and you get to keep the call credit spread uh, premium, just the full amount from both sides. So it's a very lucrative strategy if you're able to adequately predict when the market's kind of go sideways, which I actually think is almost easier predicting sideways movements than it is to predict even the direction of the market. So it's more of a, if you can build out filters for yourself on days when the market's likely to go sideways, those are going to be the best times to employ an Iron Condor or some kind of credit spread. So yeah, usually they have the same expiration. You can do Iron Condors that are week out, a day out. You can do same day, which is what I do a lot of. You can do Iron Condors. I also do like Iron Condors like after news. So let's say news is released, some earnings event on a stock, and there's really no more news coming out in the next couple of weeks. So I like to go into stocks that just had earnings, but the market kind of has already seen the effects of those earnings, and that's a good time to maybe use an Iron Condor. There's some other things you may want to look at, like the price of where things are at, so that you can select good strike prices. But that's a great time to use an iron condor. Another good time to use an iron condor would be like, at the end of the trading day on the S&P 500. A lot of the volatility starts to collapse at the end of the day, and as long as there's not a lot of news or a directional swing in the market, usually the market will kind of taper off and not really go much of anywhere. And that's the best time to create money and income from an iron condor. Okay.
Hey traders, it's Steve from the future. I hope you have enjoyed this video so far. If you are getting value out of this video, be sure to hit the like button, click the subscribe button, and share your trading thoughts. I read all the comments, so feel free to ask any questions you have there too. On a side note, I host live trading calls like this one you are watching every day. Some of my biggest trading secrets I share exclusively to just the members in my program. I host these live trading calls every day, Monday through Friday at 11 a.m. Eastern. I also host a basic training webinar every Monday for the newer traders and the regular COT report and sentiment trading webinars every Wednesday night at 8 and 9 p.m. Eastern for the advanced and aspiring traders. All of these calls are recorded and promptly posted on the members' trading calendars at the conclusion of each call in case your schedule does not permit you to come to the live call. All of my members have complete access to the scanner. We call it Steve Scanner. This is an institutional grade trade alert scanner that picks the direction of the week on all 28 major currency pairs and includes trading instruments like gold, silver, NAS 100, US 30. Just in the last 90 days, I have made over 3,000 pips just taking the top trade signals from the scanner at the beginning of the week and then just holding those trade alerts until Friday. If you want access to the scanner, you can start a 14-day free trial with the join link in the description to get started. Lastly, if you really want to be a full-fledged VIP member of my program to get access to things like the basic training course, live signals channel, Steve's scanner, trading calendars, and the one-on-one calls with me throughout the month, you can use code YouTube50, that's YouTube50, no spaces at checkout, and save $50 on your first month. Again, just click the link in the description below and apply that coupon to become a VIP member, and I look forward to helping you with your inevitable trading success going forward. Now, back to the video.
So structure, like we were saying, selling an out of the money put, buy a further out of the money put that creates a put credit spread. Then you sell an out of the money call, and then you buy a further out of the money call, and that creates a call credit spread. Again, so it's call credit spread and put credit spread at the same time. That creates an iron condor. It's a four-legged strategy. Naturally, because of this phenomenon, you're creating a defined risked trade, and it all combines into one single position. Most trading platforms like Robinhood and Thinkorswim allow you to build out an iron condor in one single order transaction, and all you have to do is just select your strike prices, which we'll do tonight actually, because it's one thing to just go over a slideshow, it's a whole nother thing to actually do it in practice, which we'll do together, which will be awesome. Here's kind of a visual. These are some screenshots I took earlier today from an actual iron condor build out for tomorrow. Not saying you should take this trade. It's just for example purposes. Okay. So let's kind of go over this. So profit zone is between short put and short call. Max profit is whatever credit is received between the put credit spread and the call credit spread combined. That is the short iron condor credit that you will receive as long as the market stays within that range. The max loss that you could incur from an iron condor is the width of the spread, okay, or the credit spread itself. So typically on an SPX iron condor, you're doing like these $5 strike separations, as you can see in my example here. And the potential loss that you could incur from an iron condor is the difference between like your call strike price and your that you sold and your call strike price that you bought. It's the insurance that you bought on the other side. And so the difference is if the market kind of goes past your, your strike price, and if it goes up to your up to or beyond your insurance that you bought on either the call credit spread or the put credit spread, that's what you could potentially lose. Okay. Break even is the short strike plus the credit. So yeah, exactly. So it's the short of the put or the short of the call, and then if you add the credit in as well, if the market goes beyond that's where you start to lose money, which happens pretty quickly with an iron condor. If a market starts to go pretty close to your strike price and there's still time before expiration, usually condors they tend to evaporate their profits really quickly. So if you get some late day gamma risk where the market's moving quickly, these things will pop off and iron condors will, on a volatile day, just get destroyed. So you really want to make sure that you've got good filters and good ways to find sideways moving markets. And like I said, if you do this pretty well, if you find some pretty good filters, you should win this trade, an iron condor, a late day iron condor, 85 to 95% of the time. Right now, I'm winning 93% of the iron condors that I've put together. And I'll show you exactly the settings that I use and how I predict a sideways moving market, that works really, really well. Okay. So an iron condor example, it would be if you had a stock that's currently trading at $100 per share. What you would do to create an iron condor is you would sell a put at $95 as an example, and then you would also buy a put at $90, and that's the protection that you're buying in case the market goes below. If it goes really far to the downside, you got to protect yourself. And that's what's called the wing, by the way. So the wings of your iron condor is the protection order. So that buy at $90 put is to protect you in case the market does go down really hard. That's the wing of the strategy. Then you also turn around and you sell a call at $105. You collect a credit for doing that. And then you turn around and you buy a call at $110. And that's the protection or the other side of the wing or the opposing wing, that is protecting you in case the market goes up a lot during that period of time. Okay. So those would be four trades that would make up an iron condor. Again, it's a four-legged trade. The total credit you receive on the iron condor would be an example of, let's say, $2. Maybe you'll earn $1 from each credit spread for a total of $2. Okay. Max profit is $200 per contract. And then your max loss would be about $300. Break even would be $93. If the market dropped down because of the $2 credit that you're receiving from the put price. And then you have from the call, call that you're selling at $105, you're receiving a credit. And the difference creates that, if the market went up to $107, you would then break even on the iron condor. And then if it went beyond that, you would actually start to lose money. And your maximum loss would be if the market basically went to either $110 and beyond, or if it went to $90 and below. The good news is if the market went absolutely insane, like let's say the market went to $150 in this period of time, well, you can only lose the max loss of $300. You can't lose more than that. If the market were to go below $90, which is your insurance that you've purchased on the put, if the market were to go to, let's say, $50 in that same expiration time that you've got on that iron condor, again, the worst thing that can happen is you lose the max loss. It works regardless of the price. The company could go to zero, and this is still the max loss that you can incur. So that's another reason why the iron condor is such a popular professional trading strategy, is because it's a defined risk trade. Obviously, there is risk involved, and we take on that risk, obviously, to trade the iron condor, but it's not like you're going out and risking, you know, your entire account on one single trade. In fact, in just a moment, we're going to get to a slide on risk management and position sizing that will help you a lot as far as figuring out how much money to put on an iron condor. Why do iron condors work? Mostly because of positive theta. So they benefit from time expiration as time goes sideways. and the market does nothing, you benefit just from the market going sideways and from time expiring. When the time expires, you collect income just from the theta decay. So theta decay is where you make a lot of the money from iron condors. They're also extremely high probability setups. Again, if you're looking to create daily income or weekly income, iron condors is one of the best ways to go because of the amount of credit that you can receive from selling an iron condor. And really, what you need to make an iron condor work is having some kind of volatility contraction edge. So, if you're pretty good at predicting if the market's going to go sideways, again, that's the time to use an iron condor. You don't even have to predict the direction. If you don't think the market's going to go up and you don't think the market's going to go down, you just think it's going to go sideways. Again, iron condor is a fantastic trading strategy. Okay. Um, Probability advantage. If both short strikes are at 25 delta, you have a 75% probability of each side expiring worthless. Um, High probability of staying in range. Losses will happen, but size matters. Okay, that's a slide that we'll just summarize in another slide. Iron condors work best in range bound markets, high implied volatility, and after volatility spikes. So for example, when I trade an SPX 0 DTE iron condor, best time for me to trade one of those is not during the first hour, first of all, because most of the transactions that occur during a trading day happen in that first hour of trading. So I usually like to wait a couple of hours until after the market's kind of settled down from the morning activity. And but it's still the implied volatility is still declining from the day. And so you still want high enough implied volatility from the early day activity where the market's still settling down, but you're catching it as it's settling down. That's the important key with the iron condors. Okay. So if you find a market that's just sideways and it's never volatile, those are going to be tough iron condors to trade because if the market's never volatile, then no one's going to want to pay for premium. So you do need to find something where people are actively paying for premium, where you can still collect premium that's going to give you premium decay from the theta and from just or volatility crush is what really is happening. As volatility gets crushed, you're going to benefit from the volatility crush and the fact that theta is going to rapidly decay that condor as well. So really what you're doing, if it's not clear yet on what we're trying to do with the iron condor, is we are harvesting premium is all this really is. Okay. You really don't want the market to move during these periods of time. You literally make money when the market goes sideways. And the more sideways it can go after a high volatility regime, if you can sell while it's still kind of high volatility, and then the market goes into sideways, those are the most profitable iron condors. And if you can find an edge that gives you that, you're going to get consistency after consistency after consistency that's going to allow you to be very, very profitable. Okay. Theta advantage. Obviously, we talked about that earlier. Time decay is where you make money. Selling options. Managing iron condors. Okay, so this is an important slide right here. So a lot of the times when I'm doing an iron condor, if once I get an iron condor that's up 50 to 70% of the possible earnings that I could make from the iron condor, I usually close half the position and I'll leave the rest to go. For example, with an SPX iron condor, I'm typically taking profits, about midday, maybe around 2 o'clock, maybe even three. If there's a lot of profits there and I've made, 50 to 75 or even 80% of the possible profit, I'll take a lot of it off the table and then leave the other half of it to run the rest of until expiration. Okay. Um, you you shouldn't necessarily hold to expiration in most circumstances. The reason why is because there's always that late day gamma risk, especially with the zero DTE option. Okay. And so again, you're just trying to capture the benefit of a little theta decay and volatility crush. If you can get a little bit of those two things combined over the course of just a couple of hours on a daily iron condor trade, that's going to give you 50 to 70% of the possible income that you could make from the iron condor. Now, I usually want, if I get up by usually 2 p.m. Eastern time, and if I've made 50 to 70% and the market is so far away from my strike prices, I will leave it to expiration. But if we're kind of getting, if we're leaning close to one of my strike prices, it's probably a good idea to just take the whole thing off the table so that you don't get caught in case the market does something silly late in the day. Okay. Um, okay, let's talk about butterflies. So hopefully we cover what an iron condor is. We have enough time. We should have enough time to go over this, but I'm going to show you guys and I'm going to quote out an iron condor in Robinhood, and I'm going to show you how I trade iron condors every day with SPX, okay, which is basically the options equivalent of the S&P 500. It's a cash settled S&P 500. You can't even trade stocks on the SPX. It's the equivalent of the S&P 500, but only for options. That's what the SPX is. So if you didn't know that, you learned something new today. And so I'm going to show you how I trade the SPX for iron condors, which is really awesome. And what's nice about that is you're just trading the general market. You're not even trading like a specific stock. You're just betting on the market going sideways the rest of the day, and that's where you're again that it's nice to just have one stock to focus on. Okay, so what is an iron butterfly? This is very similar to an iron condor. The difference is that the profit of the where you make money with an iron condor is, or excuse me, with an iron butterfly is very specific. And so you have, with the body of a butterfly, it's a much thinner. How do I like? They got these big wings, but they're a little bit thinner in the middle, right? Condor, bigger bird. I'm trying to think of a good way of explaining this, but Condor has basically a much bigger range where you can be profitable, but an iron butterfly is a very thin range where you can be profitable, but it makes more money if you can get the market to settle right around your strike prices. Okay. So let me explain what I mean by that with an iron butterfly. This is a less common version of it's basically an iron condor. Um, it, yeah, it's basically an iron condor. It has the same mechanics of an iron condor because you're doing a put credit spread and a call credit spread. The difference here, though, sorry guys, let me turn off my phone. There we go. The difference is that there is, like I said, you have to be pretty accurate with where the market's going to end the day with an iron butterfly, and you'll make more money if you're really accurate about that. But if you're not, and the market gets really close to your strike prices with an iron condor, you would actually still make all your premium. With an iron butterfly, that can actually depreciate, and you'll actually make less money. Oh, and you'll see as I explain it. Let me go ahead and explain it, and it'll make more sense. So an iron butterfly is you sell an at the money call. So instead of an out of the money call, it's just where the market is right now. So naturally, what's going to happen because of that? You'll collect a lot of premium. Okay. Immediately, you're collecting a ton of premium for selling an at the money call. If you sell an at the money put, which is what you also do with an iron butterfly, you're collecting a ton of premium from that. So you're collecting premium from the at the money call, premium from the at the money put. You're loaded up with premium, but you're also loaded up with tons of obligation, right? Because if the market doesn't stay basically right there at the end of the day, you could be in a little bit of trouble with that iron butterfly, because if the market does start to take off either direction, you could be on the hook for a lot of money. Okay. So, but I'll show you how to protect yourself as well with an iron butterfly in just a second. You also need to buy further out of the money protection on both sides, just like you would with an iron condor. But the difference is the wings are wider. So again, if you kind of think about like picture a butterfly in your mind, butterfly has small body, thin body, long body, huge wings. Iron condor also has big wings too, but he's kind of a thicker guy in the middle, right? Thicker guy. And so there's more opportunity in the middle with an iron condor for success because you've got this bigger body of weight in the middle where the market can navigate in between one side and the other side. But with a butterfly, it's just this little thin little place where you can make money. But again, why would you do this? If it seems so like you're not going to make as much money, people like the iron butterfly because of the profit potential if the market just does stay almost exactly where the market price is. If you bet that correctly, there's a lot of premium to earn. Okay. So on our butterfly structure is sell at the money call, sell at the money put, buy an out of the money call, buy out of the money put for protection. You get a lot more credit, but there's a narrower profit range as we already discussed. Okay. Here's an example of an iron butterfly. So if a stock's at $100 and you sell an at the money call, earn a ton of credit from that. And then you sell an at the money put, also earn a ton of credit for that. And then you also go out and buy protection. You buy a put at $95 and you buy a call at $105 for protection. Your credit received net between the four-legged trade there is $5 in credit in this example. Your max profit is $500 if stock stays exactly at $100. If the market even changes like a few pennies, which it can do, that starts to degrade over time. Like that can start to you won't make as much it'll start to go away. The further the market gets away from that at the money call and put. So you want to add up, you want to find out how much you're making from selling the call and adding the and selling the put. And that total credit is going to be kind of like your wings. And then you've got those further out of the money uh, calls and puts that are protecting you if the market goes way out of the way. Okay, so there we go. Condor versus butterfly. By the way, I don't even do butterflies. I'm just teaching them just so that you know them. And it's more for information. I don't even trade butterflies. I'm not saying that you can't. I'm sure there's a lot of people out there that make money or have strategies that work with butterflies. I've just always been with the Iron Condor. So wider profit range with the Iron Condor. I like that because you get that wider range. You can be wrong to some extent and still make money with the Iron Condor. You are going to earn a little bit less credit because of that wider range. But like I said earlier, it's more forgiving because of the wider range. Lower risk concentration is also a benefit. With the Iron Butterfly, you have a very narrow profit range, but because of that narrow profit range, you end up collecting more credit, which is great. But you have to be more precise. And if you are correct in your preciseness, you're really good, and you're going to be in a really good spot with the Iron Butterfly. You'll make more money with the Iron Butterfly if you can get the market to land right in the middle of the butterfly itself. Condors are safer. Butterflies are definitely a more aggressive version of selling premium. Both strategies have defined max loss. You can lose the full width of the spread if the market goes outside of your call that you sell and your put that you sell. You definitely need to position size when you're trading an iron condor or an iron butterfly. They're both high probability. So they both have high probability of success, both the iron butterfly and the iron condor. Uh, there is definitely risk involved because of the probability that you're getting. Like the risk is if you do end up losing, you typically lose more. Like let's say you risk $500 on an iron condor. The typical payout that I see when I'm doing like a daily SPX iron condor is somewhere between 1 to 3 and 1 to 5. Okay, so what I mean by that is on my best case scenario, I will risk $300 and get $100 in return if I'm correct. And then if I do like a late day iron condor, very late day iron condor, you might be looking at risking $5 for every $1 in profit, or $500 for every $100 in profit that you might be getting. So, like I said earlier, that may not sound very good, and it's not good if you have a low win rate. But because the Iron Condor is basically a strategy that has the potential to win 90+% of the time if you're correct, especially if you do, out of the money deltas at 10%, 10% deltas. You could be looking at a 90% win rate with those. And if you add some filters into it as well, like I've done, you can even improve your win rate to something like 93% or better even. I actually know people that go months without even losing an iron condor trade, especially if they're actively managing them and use good filters. So it's possible you just don't even have a loss in a while with iron condors, but you will experience loss at some point. And so it is important to keep in mind that the loss on an iron condor typically is about 3 to 5 times what you are potentially making. So it will take, if you lose money, like full loss on an iron condor, it could take you 3 to 5 wins to get back to where you were. So it's something to keep in mind with this very high probability strategy. Okay. Here's some adjustment strategies you can put together. I actually had to do this today with an iron condor that I took because we got a late day surge on the S&P 500. So what I did is I actually closed out the losing call credit spread and I kept the put credit spread. So I was making money with my Iron Condor SPX today, and things were going really, really well. And then we got a late day push on the S&P 500 where I got kind of close to my credit. In fact, I'm kind of mad at myself now because by the time 4 p.m. Eastern rolled around and the market closed, if I had just kept it as is, it would have made the full amount. But it's okay. I ended up being a little bit more cautious, and so what I did is I closed the call credit spread side, and I just kept the put credit spread side, so that the put credit spread could make it the full amount of money that it was possibly going to make. And then I took a very small loss on the call credit spread side. Um, and so sometimes it makes sense while there's still theta decay to be had and the option is still valuable. If things start to go the wrong direction, you can actively manage it late in the day if things kind of go the wrong way and you can close out one side or close out the whole thing if you'd like to late in the day. You can also roll the option. So if you have an option that's being threatened, you can roll it late in the day as well. Rolling is probably not very common, especially on a same day option. Typically, if you're wrong on a same day expiration option, there's not much you can do. You just lost, right? Other than maybe closing out one side and keeping the other side to run if you feel confident about the other side. But it is important to not freeze. I think a lot of people with this strategy, they don't take a lot of action. They just think that they can just take the Iron Condor and let it go to expiration, which in most cases will make money. But there are those few occasions where action is needed at the end of the day to manage your Iron Condor. And taking action will protect you against taking some losses that you wouldn't otherwise want to have. So some good position sizing rules when you're trading an iron condor is keep it small, okay? Especially because, like I said earlier, for every $100 you're making, you typically have to put up risk of usually 3 to 5 times what you're hopefully going to make on the trade. So if you hope to make $1,000 a day, you could be looking at risking $3,000 to $5,000 on an iron condor same day expiration SPX trade. And same thing with if you do like a week long iron condor, it's pretty common as well. Um, like you could have like a trade that could go the wrong way, and even just in a week, you could lose 3 to 5 times what you're putting in if the market all of a sudden gets very volatile. Okay, so something to keep in mind there. Let's see. Yeah, never go max buying power. This is a quick way to lose all your money with an iron condor. It gets very tempting once you get really good at finding good iron condor trades, especially if you have a 93% chance of success. It becomes very tempting. I've experienced this myself to want to put bigger leverage out there where it's like, oh, wow, like, hey, I've got $50,000 I could put on this iron condor today. And if it wins, I'll make $15,000 today. But if it loses, you'd lose 50 grand, right? And so you can't, again, it gets really tempting because you can see how quickly you can basically pull income from the market. But again, if you're wrong, it can be very devastating. So a good rule of thumb is to never risk over 5% of your account on one single iron condor as a max risk. If you're more risk tolerant, excuse me, less risk tolerant, you may want to risk something like even just 1% of your account or 2%. I think it's pretty common for traders to do about 2% total of their account. So let's say you have a $10,000 in your account. Somewhere between $200 and $500 max risk in a day is pretty common risk to take on with an iron condor. And the goal with that is to make about somewhere between a half of a percent and a 1% return a day. That's your aim, is to make like about a 1% return a day. That's the idea. You're not always going to do that because obviously there's going to be some days where you can either close the trade early or you might take a loss on those days and that's going to pull money from the account. So it's not like you're going to average 1% a day throughout the entire year. But it is really common to have returns. I've seen people with returns that are typically somewhere between 25% and even 100% gains in a year trading an iron condor. And that's just with risking 3% or 2% of their account a day. That's a pretty common thing. So you can definitely make a lot of money with the iron condor and make this kind of your daily income strategy. Common mistakes. So this is really, really important because, in fact, I really got to hit this one home right here. So iron condors and iron butterflies succeed in environments where the market doesn't move. So what are things that cause the market to move or not to move? Well, earnings causes the market to move. So avoid earnings. Okay. Oversizing is a big mistake, right? So if you oversize into or martingale, which I don't recommend, or if you use martingale with the iron condor, you can get in trouble really fast. Okay, because the strategy already has a very high win rate, and because of that win rate, you typically have to risk a little bit more money to make money because you got such a good win rate. And so if you go and martingale a losing day and then another losing day, you can get into trouble. Plus, one thing I've learned about iron condors is that if the market goes into a trending regime, that trending regime can last for several days or even a week at a time. And if you constantly martingale into a trending regime, you can get yourself into a lot of trouble very quickly. Um, so so you don't want to use martingale, definitely not. In fact, you if the market starts to go into a trending regime, you actually want to look for reasons to not trade the iron condor and come back later after the market kind of cools down, which it'll inevitably the market will cool down, but that's when you want to get back in. And I'll show you how to predict, and I'll show you some of the things that I look for to see if the market's cooling down. Another common problem is selling low implied volatility. So just because a stock is moving sideways constantly is not necessarily a good candidate for the iron condor. Again, if a market is constantly going sideways, perpetually, chronically sideways, that may seem like a good idea to trade the iron condor because the market's going sideways. But what's the problem with that? Premium, right? We got to collect premium. So if the market's going sideways, nobody is going to go in there and pay money for that premium. So you need a market that's coming off of high implied volatility and going into a low implied volatility type of time. That's why people like to do like me. I like to do end of day or close to end of day SPX 0 DTE iron condors because you're coming from a place of high implied volatility and we're moving into a place of low implied volatility. Okay, so you want to sell it while the implied volatility is still a little bit high so you can collect that premium. The premium's still juicy. And then you want to go into a place where the volatility collapses so that you get to just collect that premium. Okay. So, anyway, it's just a mindset that we have to kind of create and understand when we're option sellers. Okay. And when you're an option buyer, you want the opposite. You want a place where the premiums are really cheap and the implied volatility is really low because when the implied volatility is really low, the options can be cheap and you can go in. And when the market starts to move again, those options will increase in value just because of the movement that they're creating. Another problem is holding to expirations, not typically a good idea. Ignoring volatility spikes. If the volatility starts to spike, action is usually needed. It's time to either close the trade and take the small loss or the small profit and move on to the next day. if things start to move late in the day. So you do want to jump on these while they're still while the option is still valuable. You can get rid of the option if things start to go the wrong way. But if you hold to expiration and things go the wrong way, things can get crazy real quick. In fact, let me tell you one quick example, and then we got to move on. So I was actually trading uh, well, this was several months ago. I was trading in a demo account. I was testing out a new version of the SPX 0 DTE Iron Condor. And at the end of the day, I was watching the market last 15 to 20 minutes of the day before the market closed. And I was watching this Iron Condor, and the market was basically hovering right at the strike price. Okay. And so 1 minute, the market would go above the strike price, and I would be down a ton of money, just like that. And then all of a sudden, the market would come back down and go below the strike price, and I would flip to being profitable just like that. And I didn't know if I was going to make money until about the last 2 minutes of the trading day. And the market actually did close below the strike price, and I ended up collecting the full credit, which is awesome to collect the full credit. But I was on the verge when I was testing this system. I was literally on the verge of like the strike price. And if the market goes just outside that strike price, you could lose potentially a lot of money. So you don't want to hold to expiration if things aren't looking very good. If you have a couple of hours left before the market closes and things aren't looking very good, you usually it's just close the book and come back tomorrow. That's how you want to approach it. Okay. When to use iron condors? Market consolidating, volatility elevated, no major catalysts coming up. Avoid when market's trending strongly or breaking major levels. Those are times to avoid it. Here's an expectancy framework. So if you have a win rate of 70%, your average win is $150, your average loss is $350. Your expectancy is positive over time, but only if sizing is controlled. So you would actually make money with these numbers. This is actually not the greatest example because, like I said, I usually win at like 90%, 93% of my iron condors. And there's ways you can do that. But yes, this is kind of how it looks. You're usually not making as much money for how much you're risking. So it's a little upside down that way. Let's actually cover this one real fast, then we got to move on because I want to show you guys. I want to quote it out in Robinhood with you guys real quick. So, hardest part, that is the hardest part is doing nothing, especially if you're doing like a weekly iron condor where you're holding on for a week or two. Iron condors reward patience, discipline, structure. Um, yes, it really does. Just you one of the ways you'll make the most money with iron condors is being diligent at following your no trade day rules. So most days you're going to trade iron condors, especially zero TD, DTE iron condors. You're going to trade every single day, and you're going to get opportunities to trade them because most of the time it'll pass the test, and it's a good day to trade it most days. But there are going to be a few trading days throughout the month, or maybe even a handful of trading days, where you definitely should not be trading the iron condor. And you're going to want to trade it because you traded it yesterday, and maybe you traded it the day before. And, what if the market did really well, really well? There's always that what if factor. But if you can avoid the days where the market's really trending and moving up a lot or moving down a lot, those are going to be the days where you're going to do well by just not participating. Okay, so let's go ahead and quote this out. I want to show you guys how to build out an iron condor. So you can build an iron condor on anything technically. You can build an iron condor on like any stock that you want. Although some stocks don't do zero date to expiration. So like for example, if you wanted to do an iron condor on, I don't know, let's say Costco. Okay, let's say you thought Costco wasn't going to go anywhere for the next couple of days, right? Like, or maybe even a week. You could come in here and hit trade options and you could go ahead and start to build it out. But remember, Costco does weekly options. So you're not going to be able to do an iron condor daily, but you could do one that expires every week. You could do one that expires every 2 weeks. So if you felt like Costco wasn't going to go anywhere for the next 2 weeks, you could build out one like that. I like to do the daily SPX one. So again, SPX is the S&P 500 index, and you can't trade stocks on this. It is an only options asset derivative. And so when you come in here, this is meant for you. That's the cool part about it. This is for people that want to trade options, which is really cool, but want the exposure of the S&P 500. This mirrors what the S&P 500 is doing. So you can see its growth over time. That's 1 year. Here's 5 years growth over time. You can see it going up, 79% in 5 years. That's just your good old S&P 500, right? So we go ahead and click buy or trade options rather. And here are the options that you have. So you've got zero DTE. When it says zero, that is talking about today. That means at 2 o'clock Mountain, 3 p.m. Central, 4 p.m. Eastern, this option will expire worthless. Okay. Well, not worthless. It'll just expire. I shouldn't have said worthless. Hopefully, it expires worthless if you're selling it. If you're buying options, you hope it does really, really well, right? So, okay. So, if we wanted to do one for tomorrow, which tomorrow is the 3rd of March, we would click on March 3rd. And so these are the current prices for those options and their different price strike selections. Okay. So typically, when I'm building out an Iron Condor, what I like to do is I like to come into the market somewhere between 12 p.m. Eastern time and 2 p.m. Eastern. So you might want to write those down. And I like to check to see what the volatility regime is like at those hours. Okay. If the regime is pretty quiet and settled and a lot of the market volatility already happened and the VIX is pretty low and the volatility index is not really high, play on, game on. We're going to do an Iron Condor. If the market volatility is pretty high, it's not a day you want to do the Iron Condor. And I'll show you how to figure that out. Okay, so one of the things I do with an Iron Condor on a zero DTE Iron Condor is I'm looking for 10 delta. So again, you might want to write that down. 10 delta for my strike selection. So if I want to sell a call, I'm going to go up from the current price. Here's the index value right here. And we're going to go up to 10 delta, which would basically be a chance of profit right here. It says 90.52. It's probably because, there you go. Yeah, the delta is 10, it's 0.10 basically. So I'm looking for 10 delta. Why 10 delta? What does that mean, guys? You guys know what this is. We've talked about delta many times over the last 5 weeks or so. So 10 delta means that there's a 10% chance of this option expiring in the money ITM. So if an option has a 10% chance of expiring in the money, it also has a 90% chance of expiring worthless, out of the money, worthless. Okay. So I like to sell these because there's a very low chance, just objectively speaking, that this option would be valuable at the end of the day. So that's a good option to doing the Iron Condor on, at least from my perspective. Now, some people like to do tighter Iron Condors where they get more aggressive and they'll look for, 20 deltas or something like that. Let's see, here's a 20 delta right here. That's a lot more aggressive, and the market often does, I'd say frequently enough that it scares me enough that it can actually trigger and become valuable. You will earn more credit for doing that, but it is a little bit more of a dangerous proposition. So something to keep in mind. Before I move on, let me just answer this question real quick. Paul says it sounds like these strategies require active trading and time commitment while the markets are open, or am I misunderstanding? Yeah, to I would say to some extent you do need. It's not a set and forget like say the weekly trades from Steve Scanner or maybe the overnight trading strategy. Um, Usually you have to come and visit this 2 times a day. Number one is to check to see if it's time to open the trade. If it's a good time to open, you go ahead and open. You'll usually come back a couple hours later to see where the market is. If the market is looking like it's trending closer to one of your strike prices, it's probably time to close and take the either small loss or the small profit and come back the next day. If the market's doing well and you've made 50 to 70% of what's possible through theta decay, which is most common, I usually just leave the trade open to expiration, I might take half profits and leave the rest of it to run to expiration. So yes, to answer your question, takes a little bit more active management, but it's again, I think it's awesome. Like if you've got the time to just check on the trades, you know, take 10 minutes to take the trade, 5 minutes to take the trade and select your strike prices. It's great. And then if you've got the 5 or 10 minutes to close the trade in the afternoon, you're great. Plus, sometimes if you don't have the time to, it's okay. A lot of these will still expire at expiration worthless, which is perfect because you'll just collect the premium. But I don't necessarily recommend that. I do think it's good to give it one last look at the end of the day to see where it's at. Like today, for example, I got close to my strike price on the buy side or on the call side. So I decided to close the trade on the call credit spread side and I left the put credit spread side open. So anyway, there is some active management that way. Okay, so let me go ahead and show you how to do this. So you put it in your shopping cart, right? So if we go find that 10 delta again right here, I'm going to go ahead and sell that call. That's called a short call. Then we go ahead and buy a call. Usually just go up $5 from that for your wing, for your protection. And then you go ahead and sell a put to create the put credit spread. And again, you're looking for the 90 delta, or not 90 delta, you're looking for the 10 delta, pretty close to it right there. That's 67.70 strike price for tomorrow. We go ahead and sell that one. And then we go ahead and buy a put right here, $5 away, and that's an Iron Condor. And so one of the cool things that Robinhood does is they actually tell you what you're about to do. And so when you're setting up a trade and you put your shopping cart together, it tells you what you've created up to that point. So for example, if I delete these two trades, I've created a call credit spread. And then if I want to complete the Iron Condor, I need to basically I need to short a put credit spread. And so the way I would do that is I would sell a put again, and I usually go for the 10 delta right there. And then I need to go ahead and purchase the $5 away from it for my wing, and that completes the Iron Condor. And so I could go ahead and take this trade. This is what it looks like. So here's your Condor right here. Here's his wings. Here's his body in the middle. And here's the two wings of the Iron Condor. And so what's my max profit on this? I make 110 bucks if I win. As long as the market stays within that range, I make money. If it goes outside of that range, I lose $390. So again, there's more risk associated if you lose. The good news is I have a 90% chance of success, and I can increase that to 93% or higher if I use a few filters. Okay. So what are those filters that I use? And we have like 5 minutes left, and I think this is enough time to go over them. So here's what I do, guys. Let's just kind of review. I'm going to go ahead and put that away. So here's what I do. First thing I check for every day, actually first, before even that, both are important, is I check Forex Factory. Let's go see what the news is like. I really should, I kind of bit the bullet. I really should not have traded the Iron Condor today. It actually would have worked out if I had just left it to expiration. But we had an incredible amount of news this last weekend, and probably should not have messed with it with all the stuff going on in Iran. Okay. So if you have a lot of geopolitical news, like more than the typical, like if we're starting a war type of thing, you should probably not trade the Iron Condor. Okay. Just really basic stuff. If you got big thing going on, like back in 2022 when we had the Russia invading Ukraine for a couple of weeks, when that first got going, that probably should have been like a week or two off of Iron Condors. Okay. Or at least for the first couple of days when that started, that should have been like risk off, no Iron Condors. Okay. Another thing you want to check for is big major red folder news. We didn't have that today, so that's one of the reasons why I was totally good for going with it. We did have some ISM manufacturing PMI, which I don't really care about that. I only care if it's like FOMC, consumer sentiment, labor market stuff, and what was CPI, so inflation. Okay. So those four things. If it's any one of those four things, then it's usually a day off with the Iron Condors. Okay. So as long as we don't have those, you're good to go. And then another thing too is late day news, especially if you get like a planned speech by Trump or a planned speech by Jerome Powell at the end of the day while the market's still open. That's another day you may want to consider not trading the Iron Condor. Okay. So just keep in mind for stuff like that. So check here first. If you don't have a lot of news, like today wasn't a lot of news, typically it's a good day to get into an Iron Condor. Okay. How many of you know what the VIX is? I know some of you got to know what it is. So VIX, go check the VIX. Here's a good, there's two things you got to do. So this is my second layer of figuring out if it's a good day to trade an Iron Condor. Okay. If the VIX is moving up, which today it was actually up like 8%, that's usually not a good day to trade an Iron Condor. Okay. Iron Condors, I usually want the VIX below 22 bucks, which right now it's pretty close. Like it actually earlier today, it got up to like, it actually did get up to $25. Now, one of the reasons why I actually got into it is because it was sloping down. So if the VIX is sloping down, it's usually a good day for an iron condor because that means volatility is shrinking. Okay. Now, if you see the VIX actively moving up, if it's having a day where the VIX is up several percent and the curve is deeper than 45 degrees to the upside, steeper than 45 degrees, and you're above $22 on the VIX, that's a no trade iron condor day. That is a volatility regime type of day. You don't want to be in the markets when the markets are doing that. So, see this huge spike here? That's the spike that came from the Iran news over the weekend that initially came in at market open. Now it did decline, and that's one of the reasons why I got back into this because I did go below $22. So I did kind of a later day iron condor, which I probably should have stayed in. Kind of, I realized I probably should have stayed in it, but I ended up just cutting it because um, there was a lot of news over the weekend. So this is like right here. Do you see where the market's over here on February 24th? Let's see, 23rd, 24th, 25th, and even 26th. Do you see how the market's declining on the VIX? Those are perfect days to trade the VIX. So if you see the market just kind of going sideways, 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 or even down a little bit, sloping down, and we're below $22 per share on the VIX, perfect day for the Iron Condor. If you get a day like this where it spikes, okay, and this doesn't mean you can't trade it, but if you spike pretty sharply at the beginning, you may want to lay off the VIX. Excuse me, you may want to lay off the Iron Condor. And then the hard and fast rule is if you're above $22. If we're over $22 on the VIX, that is a absolute no, 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 no. Don't trade the VIX. Don't touch it. Leave it alone day. Okay. So you can actually see the VIX over time. Again, it's just a volatility index. So back over here in April 2025, we had a lot of news back over here. I think this was tariff stuff that caused the VIX to go up as high as $52 a share. And then it slowly started to kind of pull back down. And we got back down to as low as like $14 on the VIX. So again, you want a VIX that's sideways or mild, below $22 and sloping down. That's the ideal situation for the Iron Condor. Okay, so those are the main things, and then the other more important thing that you have to do when you're going to trade an Iron Condor. This is the third thing you have to do for an SPX 0 DTE Iron Condor is you need to have good timing. So what do I mean by good timing? So best time to enter the Iron Condor is between 12 p.m. Eastern and 2 p.m. Eastern. That's 11 p.m. Central and 1 p.m. Central. And if you're Mountain Time Zone, that's between 10 and 12. And if you're Pacific, that's between 9 and 11. Okay. Those are the best times to trade the Iron Condor. So basically what you're doing is you're coming in here. Let me kind of show you how I look at this. I come in here on a 5 or 15 minute, 10-minute chart. And if I get to the end of the day and the market is fits all the criteria, no end of day news. There wasn't a lot of news earlier in the day. VIX is below $22 and not sloping up. If it's sloping down, if it's having a down day, if the VIX is having a down day, that's almost certainly an Iron Condor day. Okay. So just check the VIX. If the VIX is having a bad day, or if it's just having a sideways day, perfect day for the Iron Condor. Okay. So you want to come in here between that window I just mentioned, set up the Iron Condor with 10 deltas, and that's the time to get in. So here's what I'm going to plan on doing, guys. And you guys tell me if what you think about this, but I was thinking about posting my Iron Condors in the Telegram. So if you guys want to take the same Iron Condors that I'm taking, I'm going to post those in Telegram, and then you guys can take them yourselves. And then yeah. Would you guys like that? I don't know. I'm just curious. I'll see if there's interest in doing that. So basically what I would do is I would just post it in Telegram with the strike prices selections that I've chosen. And then you guys can decide if you want to get into the same Iron Condor trade. And then I'll let you know throughout the day if I close it or leave it to expiration. So sweet. Okay, cool. There is some interest there. Sweet. Yeah, I'll definitely start posting those, which will be good. Okay. Well, great. I think that's about it. So we don't really have much else to discuss other than I'll just kind of review what we're doing next week. So next week we're going to talk about strangles and straddles, which are more directional strategies, and volatility expansion strategies, buying at earnings or before earnings. So this is what a lot of people like to do, is this type of trading. And if you do it well, it can be really, really good, because buying before earnings can be good. Although the one downside to buying before earnings is the premiums typically go up. So it's something you have to have high conviction behind. If you believe that the stock is going to go up, then usually buying earnings is a good thing. If you think the stock's going to go down, then buying puts is a great thing to do. But it's a terrible thing to do if you get it wrong. So that's why I like consistent theta harvesting strategies like the Iron Condor. Okay, I think that's about it, guys. So I appreciate each one of you. Thank you for coming. Have a fantastic rest of your evening, and we'll see you guys in the next webinar.